Jerome Powell. He was testifying before the Senate Banking Committee today, mostly about interest rates, which is what he normally talks about. But in the question and answer period that followed, Minnesota Senator Tina Smith asked about the availability of mortgages in disaster-prone states like California. And the Fed chief, well, he stepped up on this, and here's what he had to say.
Those banks and insurance companies are pulling out of areas, coastal areas and things like that, or areas where there are a lot of fires. So what that is going to mean is that, if you fast forward 10 or 15 years, there are going to be regions of the country where you can't get a mortgage, there won't be ATMs, there won't, the banks won't have branches and things like that.
That indeed, if things play out as they are, there is no financial incentive to issue home loans in places like California.
Federal Reserve Chairman Jerome Powell recently made a concerning announcement that could significantly impact the U.S. housing market. Within the next 10 to 15 years, certain areas may lose access to mortgages, meaning no loans, no bank branches, and no ATMs. This development could fundamentally change where Americans are able to purchase homes. Why is this happening? During testimony before the Senate Banking Committee, Powell explained that financial institutions, both banks and insurance companies, are already beginning to withdraw from regions prone to natural disasters, including coastal areas vulnerable to hurricanes, regions frequently affected by wildfires, other high-risk zones impacted by climate change. The consequences of this withdrawal could be severe. Mortgage deserts may form, areas where obtaining a traditional home loan would now be impossible. Banking infrastructure could disappear from these regions. Without mortgages available, property values might decline 25 to 50%. This crisis is developing rapidly. Powell's warning isn't about a distant future, it's already beginning to unfold. Major insurance companies are pulling out of entire states, including California and Florida. Formal Federal Reserve analysts predict that mortgage availability could drop by 60% by late 2025. Meanwhile, institutional investors anticipate a 40 to 50% increase in rental demand. Is this a time for Wall Street to step in? How the mortgage crisis unfolds. The process technically follows a predictable pattern. 1. Insurance companies withdraw from high-risk areas. 2. Without insurance coverage, mortgage lenders stop issuing home loans. 3. As mortgages become scarce, property values decline due to fewer potential buyers. 4. Local governments experience reduced tax revenues from falling home values. 5. This creates a cycle of decline. Fewer services lead to businesses exiting and further deterioration of the area. Investment strategies emerging. Institutional investors, Wall Street, view this situation as potential opportunity. Approximately $83 billion in investment capital is positioned to take advantage of what some are calling a generational buying opportunity. Some investors project returns up to 300% in regions where homeownership rates will fall and rental demand will increase. These investors are strategically targeting entire zip codes, preparing to establish dominance in the rental market. Implications for homeowners. For those considering a home purchase, delay could prove costly. Consider acting sooner as mortgage availability might decline dramatically in certain areas by the end of 2025. Research insurance availability. Insurers withdrawing from the area serves as an important warning sign. Evaluate less disaster-prone areas, as inland areas with stable insurance options may offer better security. Prepare financially by saving for a larger down payment of 25 to 30% and improving your credit scores to 760 and above. The emerging housing market structure. The U.S. housing market appears to be evolving into a three-tier system. Tier 1, areas where traditional mortgages remain available, though with stricter requirements. Tier 2, regions with limited mortgage availability and high insurance costs. Tier 3, zones where mortgages become unavailable, requiring buyers to use cash or alternative financing. The conclusion. preparing for the change. While Powell suggests a 10-year timeline, some analysts believe these changes could happen in the next 3 to 5 years, resulting in fewer lenders, increased climate risk, and declining home values in certain regions. For those in the housing market, now is the time to plan thoughtfully and stay informed about these potential shifts in the mortgage landscape. Is it time for Wall Street to take over Main Street?